Let's go ahead and get this started for this afternoon. First, I'd like to say thank you all for singing happy birthday to me over lunch. I appreciated that. I will also say, though, that over lunch I got a text from my children, and they bought me tickets to the Fleetwood Mac concert up in Kansas City. So, you know, they outdid you. I'm sorry. You know, I appreciate the song, but you understand. Anyway, thanks for coming back after lunch, and I think this afternoon's presentations are going to be very good. I'm very excited that both speakers are here. I'll say a little bit more about that later. Right after lunch here, I didn't purposely put the females on the agenda after lunch, but that is in fact where they are. Julie Niemann is with Smith Moore & Company, and Julie has done a lot of radio work and television work and interview work in the financial press and the lay press, just trying to explain what in the heck is going on, really, a lot of times. I mean, over the years that I've known her or that I've been aware of her. She is the Executive Vice President of Research and Portfolio Management at Smith Moore & Company, which is that small little brokerage firm in Clayton, Missouri, who's grown significantly under the leadership of Jim Dortch, who's here someplace and on our board of advisors right here. You know, sorry, that's going to cost you, by the way. You understand that. She's a chartered financial analyst. She's with over 40 years of experience in the investment industry, and I don't know how she could do that. She can't be old enough to have 40 years of experience in the investment industry. Did I score points on that one? She went to Fontbonne College in St. Louis and got her MBA from University of Missouri at St. Louis. And I mentioned places she's been on public radio, but she's been on Marketplace, The Morning Report, KWMU, and Metro News, and on national public radio shows, including Talk of the Nation, To the Point, All Things Considered, and KMOX, that's a local, is that national? I guess it is. I don't know it.
Short broadcast here.
Okay, and anyway, I'm sorry. And she's been quoted again in the St. Louis Post-Dispatch, St. Louis Business World, Wall Street Journal, USA Today, New York Times, Forbes, Fortune, et cetera, et cetera. Probably the thing, she's affiliations include the St. Louis Society of Financial Analysts, the National Association of Petroleum Investment Analysts, I love that one, Association of Business Economists, and probably the one that I find that I'm most excited about is that she was a member of the Rotary Club 11 Endowment Committee. So you're a fellow Rotarian?
You bet.
All right. So here we go. Living the Rotarian creed of service above self. Please join me in welcoming Julie Niemann to our podium. Thank you, Julie.
Thank you very much. Well, thank you all for coming today. Now, we just had a huge lunch, so keeping in mind that almost everybody is ready for food coma, I'm going to start out with my conclusions first. Where are we going? We're going very slowly. First of all, no inflation. There's absolutely no inflation out there. It's, in fact, disinflationary forces pushing again. Korea basically is going into very doggone close to deflation. This is going to be a serious problem for us globally because that is used to be a rapidly growing country. We're looking at the reason the market's pulling back right now. Deflationary influences coming back in on here. That's why you're seeing commodities plunge and gold. Whoever thought gold would take that kind of a hit? But we'll talk about that eventually here too. Now, one thing you may notice, especially those of you who are financial planners, you're talking to your clients, no inflation? That's right. It's called buyflation. Everything you buy is going up. Everything you own is going down. That's how it works. Wages, no real progress. We haven't had those in 20 years. If you're getting a raise, all right, that's wonderful. You're a rarity, okay? When you're looking at what's happening with productivity, that's doing it more, doing it better, doing it for less. Man is being replaced by machines. It's going to continue on. That's giving us great productivity. So there's no inflationary pressure out there as far as the Fed measures it. And that's the key thing, because that's where the cost of living accelerators come in, everything comes in. And that is why we're going to have QE-ternity. And that means QE3 going on and on and on, or at least until Ben Bernanke retires, whichever comes first. Now, he's announced that he is not going to do anything until he sees unemployment down at 6.5%. I hate to tell you, folks, the new normal is 7. The real unemployment rate, and that includes all the people who have been giving up hunting for a job. people who are structurally unemployed, people who are working part-time. You know, we're in an era here of gigonomics. Everybody's doing gigs, trying to put together a living right now, as opposed to that wonderful long-term job that happens to be out there that had things like benefits. No, just not around at this point. If you take a look at structural unemployment, real unemployment, it's a little over 9.5%. That is the biggest wet towel on this whole economy that we're looking at right now. We're going to have very restrained lending. The banks flush with cash, tons of cash, because they're borrowing from the Fed at free, zero money, and they're reinvesting it in treasury rates at about 2%. They're making money the whole doodah day at no risk, and why should they bother to risk and lend to companies when they can make free money? Lending restrictions are very, very tight. They have money available for you if you qualify. So in other words, if you don't need it, you can get it. So that's pretty much it. This is going to really limit business expansion with this kind of an environment. Doesn't kill it, it just really limits expansion. And it's going to very much limit employment. And that's the big overriding thing. The Fed's big charge, yes, it's inflation, not a problem, but it is employment. And that is going to be the longest term negative to this economy and why we're looking at such sluggish growth here. So monetary policy, cue eternity. Gross domestic product, how fast are we going to grow? The happy talkers, I've seen a few of those out there, they're saying 3.5%. That's normal. That would be wonderful. We don't have a budget deficit at 3.5%. That would be really exciting. All the people who are saying that are product pushers, okay? 2.5% is what the majority of economists are saying right now. I say those are blinders. 1.5% is what I'm looking for. It's still growth. That's the exciting news. We're still going in the right direction. So what we're looking at here, probably the key things, and why is this putting an impediment on everything? Europe is back into recession. You know, no big surprise there. You're looking at an entire European economic union that is in total disarray. They've been kicking the can down the road forever, and it's really a huge impediment to growth there. So we can't count on them. China, this is a real danger. We're looking at China not buying commodities. You've seen pictures of their ghost cities, super cities that they have out there, nobody in them. There's huge political foment because the people want some of the goodies that have been accumulating to all the people at the top. They have huge social pressures now. They have to grow internally. And this is going to be a very big transition, but it also means that they're not going to be growing at the rapid clip everybody was used to. Japan, well, this is a case of beggar your neighbor. They just took a look at how we're doing QE and decided, wow, this is the neatest thing since sliced bread. Let's do it. And that's what they're doing, full tilt, but it's really going to cost all of their trading neighbors. Southeast Asia is going to be twisting in the wind simply because of it. So this is the reason that we're looking at very, very slow growth here in the United States. So bottom line, what recovery? You know, we're slowly working our way out here. This has been an unusual recession. In fact, I don't even think it was a recession. You do remember, of course you do, back in the 30s when we were in the Big Depression, 4 years afterwards is when they finally declared this was a depression. And why don't you tell everybody when it's going on, when you see it's coming in? Because you don't want to be unhappy and talk everybody down. And confidence, it's so important. I'm of the opinion a realistic approach to things means that you're able to deal with it then as it's happening. So this was no recession, this was a depression. A balance sheet depression. Recessions are inventory caused. You build up too much inventory, everybody gets laid off, it goes down, you crash down. And here's the big difference. This is a recession, a V shape. You go down, you come right back up. A depression is you go down and you go sideways. And very, very slowly you start to climb out. It's not even a question of depth. It's how long it goes on. And the good news is it is slowly starting to turn up now. So are we still continuing on a depression? No, but we're working our way out of the biggest disaster we have ever had in our financial history. And the marvelous thing about it is we did it to ourselves. So from this point on, if I have you food coma, we're going to go with why we got here, how we got here, and how we get out. Two parts to this whole coming out of it, after the big crash in 2008, was the stimulus, and here's how it worked. It worked, okay? The one part we know that did work was the money that went to state and local governments. That we do know worked, simply because state and local governments were looking at laying everybody off. It was absolutely catastrophic. The money that went to state and local governments kept people employed, kept teachers employed, kept lawyers employed, kept everybody in civil service employed, a positive thing. It didn't make it any worse, even as everybody else was laying off the rest of America. Now we've got the trade-off, though. Now we've got, because of sequestration and virtually everything else, everybody's being laid off at state and local and national governments, but private employment is beginning to pick up. So that's the positive thing. Where the rest of the money went was down the proverbial rat hole, okay? Shovel-ready, no such thing as shovel-ready projects. If there had been a little bit of planning instead of total panic, and it was total panic. Anybody remember Hank the Hammer Paulson, our former Secretary of the Treasury? He basically went before Congress and said, shoot, if you don't give me all the money I want, I'm going to shoot this dog. And Congress, oh, okay, here you go, trillions, take it, take it, take it. They had no place to put it. All they knew is they now had money to do, and they didn't know what to do. So what they did do was start to whiz it away. If it had gone into infrastructure, which we've known for years has been a huge problem, that would have had a great long-term sustainable situation. That's what we have to do now, is get infrastructure. If you take a look at our ports, our ocean ports, hugely crumbling, major problem with international trade. Other ports are in significantly better shape. We've got huge bottlenecks in Houston and Los Angeles, and so those are the worst ones. We need to rebuild our ports. Rails, derails, we're getting that all the time. If you want fast-speed trains, which really helps with commerce, especially in a country this size, it has to be rebuilt. Highways. We came here on Highway 70. Let me get started on highways. How about bridges? Missouri is one of the worst states in the union in terms of bridges. What are they doing? They're basically just shutting them down, which means you get to go around. Those of you in St. Louis, we've had a lot of construction on Poplar Street Bridge. Poplar Street Bridge is exactly the same bridge of one they had in Minneapolis that went in a few years ago. And there are 6 other bridges just like that. It was such a good design, they decided to replicate it, going all over. Now you're seeing everybody scramble so that we don't have more dives into the drinks here. But that is the situation with our infrastructure here in the United States. It's awful. And it's putting us in a hugely uncompetitive position with virtually everybody else in the world. That's where the stimulus money should have gone. Where we're likely to see more money going into that area, that's a positive, and I think ultimately we will be seeing it. So much for the stimulus. But this Band-Aid approach was really the worst possible way to do it. It stopped the bleeding, but it didn't do anything to move us out of the situation. The second part of the stimulus, or rather the program to get us out of the Depression recession, was the bailout. The bailout. Who did it exactly bail out? Now, I know that's pretty small print there. Let me tell you who they bailed out. Citigroup, bailout aid, $476 million. Pay and bonuses, $93 million. Bank of America, $335 billion bailout, $131 billion in pay and bonuses. JP Morgan Chase, $129 and $107. Wells Fargo, $107 and $90 billion in pay and bonuses. Goldman Sachs, oh, my favorite. Goldman Sachs, $89 billion in bailout aid, $54 billion in bonuses and pay. That's where the bailout went. The bailout did not actually go to restructuring the financial services in America or fixing anything. What the bailout did was perpetuate 30 years of corporate greed. We have absolutely no filters on corporate greed right now, and it's been going on for 30 years. If it were effective, wonderful. If it were economically made sense, wonderful, but it has not. It has literally gone to the very top and does not filter down at all. There was a discredited theory called the trickle-down theory back in the Reagan administration. Trickle down was that if things are good at the top, it will all come through, and riches will be heaped by everybody else. What's good for General Motors is good for America. Newsflash, folks, the only thing that trickles down is sewage. And here's the other problem: paying the boss. The corporate pirates, I mean leaders of America, are paid approximately 400 times what the average worker makes. Across the world, it's a 40-to-1 ratio. Is there a little disparity here? Are these guys really worth all that money? I've been in animals for 45 years, and I've met a lot of CEOs. And I can count in one hand the number of guys I thought were really worth their weight in gold. And by the way, most of them were compensated with shares of the company. Their futures were tied to the health of the company. I'm not talking about options, I'm talking about shares. They were owners. They were not ones who were trying to trigger stock options so that they could take it and run. These were true owners of the organization. So what it really comes down to is the United States has absolutely the finest government that money can buy. And who owns us? Four industries. Energy, the oil and gas companies. Now, I've been in oil and gas analysts for 45 years. I can tell you where all the accounting tricks are. And one of the best of them happens to be a huge tax credit that they get for depletion and for all kinds of other things that happen to be in there. Because when you had oil and gas selling at $9 a barrel, it takes 10 years from the time you find oil to the time they get it to the gas station. You can't do that when it's $9 a barrel. It's a very expensive proposition. So the tax credits went in, and that made sense. At $100 a barrel, you don't need it. You take it off. But once a tax credit is in there, tax advantage is in there, it almost never, ever goes away, and they defend it absolutely to the death. Energy. Agriculture. Do you realize that we could eliminate a significant portion of our foreign aid program if we did not subsidize sugar? Some of the countries to whom we give the biggest amounts of foreign aid produce sugar. But we're protecting our industry, and we have the highest sugar prices in the world because of this protection, all because of lobbying. But that's just one. The most obvious one is tobacco. Here we are trying to get everybody to stop, yet we're still subsidizing tobacco farmers. Oh, that makes a heck of a lot of sense. Healthcare, big pharma. Do you know that your Blue Cross Blue Shield, United Healthcare, they all negotiate for drugs and drug prices? You know who is prohibited from negotiating for drug prices? Medicare. They have to pay full retail price because of a special deal they got through Congress. That's a wonderful thing. And my industry, financial services. We get more of the most enabling legislation that goes through, so every time something hits the disaster, hits the fan, everybody rushes in and comes in through with forms that were a day late and $1 short, and that is a huge problem. These are the four industries that have the largest campaign contributions to Congress, to state and local government, and yes, even at your very local government. It goes all the way through the system. So my argument is, we have the best government money can buy, and we should expect that. Why didn't we see the banks go under? Because of financial services. They absolutely hollered and howled. Bankruptcy is the cleansing thing in the American economy. It works wonderfully. FDIC knows how to shut anybody down. Our courts are excellent in this way. They know how to clear out the dead wood. One of the big problems in Europe is they don't have good bankruptcy courts, and they can never get it out of the way. Well, until you get rid of the dead wood, you can't grow again. The biggest problem we're faced with right now is everybody who should have died is still walking around, the zombie banks. It's not my rule, but I really believe this. Any business which cannot get private funding for operations should declare bankruptcy without government interference. It is painful, but it's necessary, and it's the cleansing process. So there are the two things that made this big recession into a depression. We did it to ourselves. And then just add a little salt in the wound. We went over the fiscal cliff like Thelma and Louise. All the disincentives were supposed to be there so that it wouldn't happen. This was such a horrible outcome, everybody will be rational and sit down and negotiate. Did they do it? Yeah, right. So we went over the top, and what do we have to thank for it right now? Well, a lot of people are saying, hey, nothing happened. Well, that's right, it didn't blow up, but here's what's coming. Higher taxes. We're already seeing the impact of that. Any economist will tell you when you're coming out of a deep, deep recession/depression, what you don't do is raise taxes. You want to keep coins in the jeans of the consumer. And when the consumer accounts for 70% of your economic growth, you better keep some coins in the jeans here. But no, we're raising taxes here. And we're not raising taxes on the people who spend. Yes, that's a big area. But the people who are saving, namely the ultra-rich, aren't getting tax increases or not meaningful ones. So it's heading to the wrong places. So what's our forecast here? 3 economic perspectives. The glass is half empty, the glass is half full. What glass? As we know, economists have not been exactly sterling in their outlooks or accuracy in their outlooks of what's coming down the pike. This has been an amazing period of time where very few forecasts have been accurate. And the biggest reason being, you tell me what Congress is going to do. It really defies everything that's been going on in traditional economic moves. The textbooks don't work. You're having to be a political economist as well. So here's our economy. Very vulnerable. The shock's out there. Plenty of things can go wrong. But good news is we're swimming. We're still swimming. The biggest thing we have, though, is debt, a huge amount of debt. And that's what basically took us into this. This is debt recession. And it's a global debt situation. We got into it because of the mother of all bubbles, the housing bubble. Anybody remember back to 2000? Nothing but net, Y2K. That year, Pets.com was one of the big sponsors of the Super Bowl, the talking sock puppet. Okay? Pets.com had a market capitalization bigger than Microsoft, a real company. We knew this was speculation. We knew this was idiocy, yet everybody still continued to buy .com anything. We knew it was going to blow up, and it did. The difference with this was one that went through the entire American economy. Real estate, oh, we know they're not making any more. It only goes up. When they started interviewing people in Miami, Florida, hairdressers who had 4 and 5 condominiums and were flipping them, game over, boys and girls, when anybody could get into it, and that's what was happening. Who was letting it happen? Why, our friendly bankers and the liar loans. No money down, no deposits, no collateral, no credit checks, no anything. What were they doing? Doing nothing but getting the fees. This amount of debt, unfortunately, is deflationary. Debt is inherently deflationary. And that's why we can't make any progress moving here. It absolutely offsets any kind of economic growth that you have going on until you get rid of the debt. How do we get there? Well, for you youngsters in the crowd, I'm going to give you an alphabet soup lesson. SIVs, CDOs, CMOs, CLOs, CRAPOs, these were all the wonderful instruments of mass terror that were going on in the financial services industry. These debt instruments had no value. They were taking mortgages or some asset, packaging them, slicing and dicing, and then selling it out to every institutional portfolio that happened to be out there. In fact, a lot were sold internationally as well, because Goldman Sachs and Merrill Lynch had these wonderful products for you arrayed, and who can possibly turn down a slick investment banker? And that's what they were doing, selling this garbage absolutely everywhere. I was estimating back in 2008 that these CDOs, CLMOs, CMOs, CRAPOs, all were worth about 10-to-1 removal. Here's your intrinsic value, the original mortgage, and here's the market price here. I know they were AAA rated by Standard & Poor's and Moody's and blah, blah, blah. They clearly were not doing their credit analysis. That was obvious. I was wrong. Warren Buffett said it was 30-to-1. That's how bad it was. So there is absolutely no intrinsic value, and that's why Wall Street totally melted down. Because there was no oversight, no supervision, absolutely no disclosure. So what would have been a bad disaster in terms of real estate turned into be catastrophic because of fraud on Wall Street. And it took out the Western world banking system. Yes, we did die. We went over the edge. 2008, we were toast. After Lehman Brothers, we were dead. But we were resuscitated at the last minute through a massive meeting in Washington, D.C. of all the world's central bankers who basically turned on the spigot, and that was it. And slowly things came back. Every time we've come out of a recession, it has been due to real estate. In 1981, 1990, 2001, real estate was the thing that lifted us out because real estate has the most marvelous job creation factor. It's not happening this time, and that's the huge problem that we're faced with now. What used to be the engine that would bring us out is not around. The U.S. housing economy, basically when you're taking a look at gross domestic product, 2.3%. That's what it adds to the economy. If we had a good real estate market, looking at historically, we would be growing 2.3% on top of everything else. So if you're looking at something like that, we're talking about $350 billion that could be going into the economy if the real estate market was good. Here's what it is in jobs. 2.9 million additional direct jobs, not indirect jobs, direct jobs attributable to real estate. Not happening. What we are seeing now with real estate is a little bit of a resurrection. That's a good thing. But we're nowhere close to going back to where we were. Why? Because we have millions of houses still available, the used housing market. Not only the ones that are currently available, but something called the shadow inventory. The banks are holding massive amounts of real estate that they haven't even put onto the real estate market because they don't want to depress prices. It's called the shadow inventory. That's about 2.2 million houses right now. And everybody knows it's out there. And that's why you're not seeing real estate really move up dramatically in prices unless you're in San Francisco or some highly desirable area where those real estate prices really are going up. By the way, if you're looking for a house, this is probably the best time you could find one. Low prices, they're not moving up, and if you can get the loan, amazing interest rates. So this is the biggest job killer we've had is in real estate. Put it in perspective. Here's coming out of recessions, what it has looked like. Every single recession we've had coming out here, here's this one. It is simply not recovering. And that is going to continue to be the huge damp, the wet towel on the whole economic recovery here. Maximum job losses, very slow additions. We're just trading, and we're treading water. New job formation. So for those of you youngsters who are currently working, my suggestion is if you're looking for a new job or you don't like your job, buck up. Because it's going to be really tough to find a new one. I tell my son-in-law repeatedly, do not resign that job until you have another one in the offing here. And that's exactly what you have to do. People are going to be working significantly longer. They're going to be sullen but not rebellious in terms of where the jobs are because new job formation is going to continue to be very difficult. And who's being laid off? Well, the great jobs. Anybody here interested in oil and gas drilling? Anybody want to drive an over-the-road truck? Welding. Oh my gosh. Welding up in North Dakota, $65,000 a year if you can weld. That's where the jobs are. And what are you training for? Office work. Office work is where machines are replacing man right on down the line. And that's where you're seeing the biggest number of layoffs and where people are not being rehired. So that's a huge, huge problem. We have a big mismatch here in the United States between the jobs that are available and the jobs that are demanded. At lunch, we were talking about where you see the biggest employment opportunities. Engineering. Absolutely. But how many people are in the engineering school? Not that many. We've got a huge problem here. Back to my original concept here. Why isn't the consumer leading us out? 70% of the economy is basically based on the consumer, trying to get us out of the problem here. The consumer doesn't have the coins and the jeans to turn around and spend. A little bit more. There's a little confidence out there. Those who have jobs are a little more confident about keeping their jobs. They don't think they're going to lose them right away. But are they out there spending like crazy? Average age of the automobile in the United States is now 10.2 years. That's the oldest on record. You remember people that every 3 years will get out and get the new car, will start cruising down the highway. Two things destroyed that. First of all, you get a big honking recession, what's the last thing you do? You don't go out and get a new car. You keep driving, you put AAA on speed dial, and you drive close to the curb. That's the way it is. You keep replacing. And now that the car is blowing up, you're considering getting a new one. Clunkers for cash for clunkers was the best thing that ever happened to the automobile industry. It destroyed the used car market. By the way, it was such a brilliant move. Germany tried it 2 years before the United States did, and it didn't work, so we tried it, and it didn't work. All it did was basically move us into a new car market. But that's been a positive because that's why new automotive purchasing is continuing on. So the good news, the very sluggish growth we're getting is due to two areas. automotive, and a little bit of housing moving up. So that's our hope right there. Those two areas are going to be the areas that continue to move us on. As far as the rest of the consumer economy, I don't think everybody is out there using their college bookshelves, the plank with the concrete blocks. We're moving up from that level, but this is not turbo growth in spending. Consumer stocks basically are pretty flat, not doing much of anything. The survivor's bias, the ones who are out there are making money. But you think about your own spending patterns. When do you go out shopping? When you have Macy's, Red Tab, 50% off, give it to me free sale. We're cheap. We're going to stay cheap. We want bargains, and that's the new consumer. We love going to any place that has a deal. Just ask J.C. Penney. Whoa, did they screw up? Nobody will go unless they have a sale. And that's what the American consumer has been for the last few years. We want our deals, and we're not going to go shop until we do. By the way, two of the hottest stores going happen to be Dollar Store and Family Dollar. So that lets you know what the consumer is there. So with that in mind, 5 words going through every investor's mind: what should I do now? Everybody still has a circle the wagons mentality, and this is not the time to be doing that. Nobody believed it in 2007, 2008, and I've got to admit, a lot of financial advisors stayed with the mantra, don't get sore, buy more, average down. Well, it became average down. Wipeout. Most of the time, averaging down has worked. It worked beautifully from 1982 to the year 2000, actually 1999. It has not worked since then. You have to be aware of what sectors to be in, because this is an entirely different economy. I hate to say it, partner, but there's not a lot here, and it's getting harder to find market returns here, and that's the biggest problem. Where are you going to get the returns? Overcoming consumers' problems, market emotions here. You start out optimism, excitement, thrill, euphoria, anxiety, denial, fear, desperation, panic, capitulation, despondency, depression. We're almost to the hope level here. People are beginning to see that, yes, there is going to be an end to it. But we're definitely not in the relief and the optimism period here. So we are going through this cycle of emotions. The good news is, yes, there is hope, and it's not a place in Arkansas. Let's talk about individual sectors here. How about the bond market? Dead on arrival, Well, when inflation, low as it is about 1.5%, 2%, real rate of inflation is probably closer to 3.5%, and you're buying bonds at zero, nada, treasuries, I'd say there probably is a bubble in the treasury market. But even as I say that, people are going to still continue to buy there. Why? Because it's a warehouse of safety. Globally, people know that if they put their money in here, in spite of stupid Congress and saying they're not going to pay their debts at one point, this is still the safest place to be. That's why you see foreign money still coming over here, even at these interest rates that are poking the eye with a sharp stick, okay? So there is not a huge bond bubble out there. There are good returns in various sectors of the bond market, but the sectors in the bond market also require trading. And that's what you're seeing now, is a lot of turnover within the bond market. New issues have not been that big, even though that's a great way for corporations to raise funds, they don't need it. So you haven't seen new issues flooding the market. The only ones who have been out there are the ones who need it, namely the junk bond markets. Remember, there's a difference between junk and trash. Junk bond markets are high yield when you're at the beginning of a credit cycle. In other words, you've been through the worst. Junk bonds are a good place to be because everybody who could make it is already dead. What you want to be careful of, though, are the ones who are now getting new funding. Who are those people? The leverage buyout kids. Yes, the hedgies are at it, and they're moving very quickly. They're going in, buying companies, taking out all the cash, and then issuing securities, largely debt. They will all die. We have Hostess. This is one. Wonder Bread, okay? They're doing leverage buyouts on it, anybody who's taking over certain portions of it. CPI tried to do the same thing in St. Louis. These are the folks at the Sears photo stores and everything. The guys, the hedgies who took it over, took out all the cash, issued debt, and the debt holders are the ones left holding the bags on the latest liquidation, and it will go into liquidation. Those are the kinds of trash bonds you have to avoid. Anybody who's doing financial engineering, watch out. If it's a company that's been around, that is cyclical, that is going to survive, that's where you want the bonds, the junk bonds. Those are viable. Now here's the kicker. How do you know as an investor? Buying individual issues is almost impossible for you as the individual investor. So you go with a fund manager. The more the yield is, the more danger there happens to be out there, rule of thumb. So go with the junk bond funds that have a respectable quality and have the lower yields. It's a substitute for stocks as opposed to bonds. Consider them as part of your bond portfolio, only as the stock portion of it, higher yield. This was the longer term trend. This is the bond market. It's been a beautiful, beautiful rally all the way through. Interest rates just going down, down, down. By the way, those of you who've heard me before, that's my hero. Yes, that's Alan Greenspan. I always refer to him as Uncle Al, the banker's pal, could not stand the man. Have you ever listened to his testimony before Congress? He would say, well, Senator, that's a brilliant question. Senator, what do you think on this? And of course, Congress would preen and everything. The man never said anything that anybody could understand anyway. It was green Spanish, we called it, trying to figure out what the heck he said. One thing we do know, he kept monetary policy way too loose, way too long. He caused this buildup. He caused this catastrophe by cheap money. When you have cheap money, people take it and do stupid things like buy too much real estate. They speculate with it. You cannot have cheap money during times of economic expansion. That's the time to start reining it in, taking the punch bowl away. He never did that. Here's the guy who's trying to make the best of a bad situation. Ben Bernanke came in the middle of the crisis. Now, everybody's been criticizing him, but you know what? There are no textbooks that went on with what's happening now. Everybody's been playing it by ear, trying to figure out what happens if we do this. It's best efforts guess. And actually, I think he's done a yeoman's job. My big complaint against Bernanke and virtually everybody in the entire cabinet who's in the financial area, they're all Eastern Seaboard think. They work for the same firms, they went to the same schools, they hobnob at the same clubs, they all think the same way. And so it really is a case of they're hammers and everything's a nail, and that's the only thing they understand. That's why, another reason why we're not getting good creative thinking about where it come from. We need more Fed governors like the fellow we had out in Kansas, Wayne. He was excellent. We need more of these, and that's when we're going to get significant change. But we do need new ways of thinking. Then to our next asset class, how about gold? Gold. Gold has been on a downtrend here for the last year. This was gold over the last week. Look at that huge drop-off all the way down here. That is absolutely shocking. Now, I'm not a conspiracy theorist, but folks, sometimes they're right. What's going on here? You had a huge short position in gold. One of the smartest men around, his name is John Paulson, head of a huge hedge fund, lost $1.5 billion in a gold trade this year. There are not too many hedge funds that can handle that. He's been on the wrong side of this particular trade. Goldman Sachs came out with a marvelous statement about a week and a half ago. Watch out below. We're going to be seeing a real sell-off in gold here. Well, the trend was down. That's a good call. But straight down, okay, what you had was a huge short position building up here. And nobody is buying it back. This was manipulation. There's no two ways about it. All the usual things out there were going around, well, we're afraid of deflation, and that's not good for gold. And the economies are slowing down, and that's not good for gold. And, you know, all the usual stuff. That's nothing new. Absolutely nothing new. This is blatant market manipulation here. So, do you step in and buy gold because it's so cheap now? No games are being played, folks. And one thing you've got to remember, take a very zen approach to the market. I always have. If I see a stock behaving not like I think it should, somebody out there knows more than I do about it. Stand back. And that's what you have to do. Stand back. When something is misbehaving in the market, it's not the time to get in and grab that falling sword. So how about the stock market? Well, don't get me wrong. I love a bull market, and the market keeps going up. But it does kind of scare you, doesn't it? When you've got price earnings multiples like this, when you've got utility stocks looking like absolutely the next great growth. Let's talk about equities here. The stock market roller coaster has left everybody dazed and confused and absolutely terrified. And that's why a lot of people are still sitting in money market funds, getting a poke in the eye with a sharp stick as far as interest rates go, because they're afraid of getting in and losing it all again. Okay? There are a number of people in their 401ks who lost over 70% of their holdings. So much for retirement. Your retirement horizon is going to be forever, and that's the big problem they're faced. Equities are very scary. Here's the market right now. Everybody's so excited because here we are. We're back up to the year 2007. Isn't that exciting? Yeah. Well, to hear Wall Street talk about it, it's the neatest thing since sliced bread, and we keep bumping up and going sideways. Typical market pattern. Whenever you hit a new high, you're going to do some backing and filling and back and forth before you break out. So here we are at 2007, and here we are 5 short years later, 2013. Wonderful. Now, just to keep this in perspective, here we are since the beginning of 2000. Look at that, 13 years of dead money. We're back to where we were in the year 2000 at the original bubble. If you purchased that wonderful S&P index fund, Vanguard index fund, you had the warm knowledge that you collected some dividends along the way, and you're back to break even. The whole point is the market doesn't always go up. Constantly reinvesting works wonderfully in a generally rising market. That was from 1982 to 1999. Now you have to pick your sectors. You have to pick where to be. It means actively managing your portfolio. Sure, you can do it yourself if you stay on top of it. You go with financial advisors who are going to give you the right direction of where to be. But buy and hold has not worked in 13 years. And there's no indication that it's going to change anytime soon. And why is that? And the biggest reason is, here's the history of the market. This is all prior to 2000, 2007, and coming back right now. By the way, that was the NASDAQ. Those were all tech stocks. That was sheer idiocy. We don't pay any attention to that. So here's the real market, okay? But you go through periods of time, approximately 20 years, where the market does nothing. Flat cardiac arrest, going sideways. And why is that? Because there's nothing to drive it. Why did the market go up from 1982 to 1999? A huge period of peace, productivity, international trading. It was called the Great Moderation. Interest rates were low, things were affordable. Sure, we had corrections from here and there, but they were called corrections. We had bear markets, but they came out. Those were called cyclical bear markets, not secular bear markets, and that's when it's down for a long period of time. From the year 2000 to the year 2013, what's been driving the market? 2 big bubbles. If that's the only way you get a bull market is through bubbles, we've got a big problem ahead of you. And that's why everybody's looking to see what's the next bubble. Nobody believes that there's good intrinsic growth ahead. What will drive the economy? Is it productivity? No, we played that game already. There's nothing out there that's a driver except for one area, and that's the emerging markets. The emerging markets are all of a sudden, they had a wonderful situation. They didn't get to any of this debt trouble. And why didn't they? Because nobody lent them any money. That works. So they stayed out of trouble. Now, though, they have a population that is, one, becoming slightly more educated and is into consumer things. Why aren't we building out infrastructure in a lot of places? Because we have cell phones and technology. They don't need the infrastructure. They can grow without it. It's a wonderful thing. So emerging markets are going to be the next greatest, best place to be. However, it's also the riskiest. That's where you have huge political instability, and most of them are commodities-based. And right now you're looking at commodities continuing to plunge because the people who use the commodities still aren't out of the soup. So we're going to continue to look at the emerging markets area as being a good place to invest, but very, very cautiously. What other areas in the market do I like? More is not necessarily better. Big boys. You know, when you're trying to turn a large corporation around, it takes forever. They move very slowly. They're very rigid against change. I like small and medium-sized companies because they can change very quickly. Now, we've had a huge run in small stocks. In fact, the last few years, it's been all small caps. And it's been great. That's been the area that's blazing. That's also the area that has the highest risk. I'm focusing on mid-caps. This is where you get the best bang for the buck. These are the guys that grow up to be big boys, and you're not taking on a huge amount of financial risk. Love the mid-cap stocks, both growth and value. That's getting pretty blended these days. We used to have those separate sectors. There are signs that things are improving. I don't want everybody leaving going, oh boy, Debbie Downer. Somebody called me that in the lunch today. There are good signs out there. Let's talk about what it is. First of all, what are those signs? Oil. I asked the dealer, what would Jesus drive? Did you ever think you'd get used to $3.50 a gallon? Not that long ago, I remember we were paying about $1.25, and it wasn't that long ago. But we have gotten used to it. And that high-priced gasoline caused us to do a couple of things. The biggest one being conservation, and 2, fuel efficiency. Our cars finally are fuel efficient. Now, there are some of us, okay, I've got a very tall husband. We try cars on for size. We drive something that gets a little bit better than 16 inches to the gallon, you know, those SUVs that are out there. But even those are getting better. But almost everybody else is driving fuel-efficient cars. That we are not net consumers of energy here in the United States. We have had very flat demand. And one of the best things coming down the pike is natural gas fracking. I know, the environmentalists out there are going, oh, God, no, this is the best thing that could happen to us. Natural gas fracking has been around for years, ever since I started following oil and gas, but it was always too expensive. This is where we're going to become energy independent, and it's going to reduce our carbon footprint. Now, there are huge problems with it, and probably the biggest problem is that companies who are drilling, other than the big boys, are not spending the money to do it properly. That's why you're seeing people setting their drinking water on fire. It's for real, okay? They're not doing it properly. Those are the smaller companies. The big boys are doing it right, the Chevrons who are out there, okay? Fracking is going to be the area that's going to keep us from importing tremendous amounts of oil. It's going to be a huge substitute for our utilities. Now, even as I say that, that's for us. The rest of the world is burning coal. So it's going to be a net offset. They're going to be burning coal because that's the cheapest. Okay? But here in the United States, at least, we're going to be lowering our carbon footprint. And it also means that we're going to be looking at gasoline prices also continuing to be relatively reasonable. We're not going to $4 a gallon, $5 a gallon. We're going to continue to go down. In fact, I would put $100 a barrel as being the ceiling on oil for the near term, for the next few years. It's just not going anywhere. That's the biggest tax to the consumer right now. If you're putting it into the gas tank instead of the grocery cart, that's a bad substitution effect. More money will be available for consumption if you're not using it to drive around. A real positive thing. Here's the other positive thing, and that is at least we're not the Eurozone. You think it's bad here. It's really bad over there. There are major stumbles to recovery for all of them, and all of them are political. In all likelihood, I think we're going to see a substantial restructuring of the European Economic Community and the Union. And that being the ones who should never have been in will be ushered out in orderly fashion. Greece, Portugal, Cyprus. Cyprus really was a catastrophic situation. Everybody poo-pooed it because of the small size of the country. But they happen to be a huge international banking hiding your money hub. That's where a lot of hot money was at, a lot of drug laundering money, and yeah, the ones who took it on the chin were the Russians. 40% of the deposits were the Russian oligarchs. When you've got shelters like that all over the world, and we need substantial restructuring in the international banking system, you're going to see a lot of corruption and money flow through that is non-productive going through. But the Eurozone has even bigger problems, and they have to deal with it, and that's lack of total productivity. You know, bottom line is, Germany is getting really tired of taking care of everybody. And they've had it pretty much. That's why you're going to see the big restructuring. And it's going to keep growth from occurring in the European Union as they go through this very necessary restructuring. And that very necessary restructuring is the debt bomb that's over there. The biggest debt, Portugal, Ireland, Italy, Greece, Spain, they have to restructure their debt, and their bankruptcy courts don't do it the right way. We ought to send our people over. We'll put you in bankruptcy real nicely. So what does it mean for our markets? Because Europe is in such bad shape. Well, we're all dogs, but we're best in show. We're looking better than absolutely everybody else. And that's why you're investing here. We're growing better than the others. We're in better financial condition than the others. And for even lack of transparency that we have, it still is better than absolutely everybody else. Every time we go through this, we do light a fire under regulatory reform. That is happening. Dodd-Frank was an amazing stab. Was it effective? Not particularly, but there are some sections of it that make a heck of a lot of sense. It'll go through retooling. But financial reform is absolutely necessary. Regulatory reform is necessary. Over the last 15 years, though, the biggest problem with regulation is not that we have so much of it, it's not enforced. That's where the government has been cutting all of the enforcement budgets. As an oil and gas analyst out on the western slope of Colorado, there are approximately 7,000 oil and gas rigs out there. They have one OSHA inspector, and their death rate is absolutely breathtaking. How does one OSHA inspector get around to make sure these guys are all obeying the rules? The drought. Remember this last summer? Ear of corn here, it says hot outside, and that's popcorn. It says shut up. The good news is it's raining. The long-term drought is not gone. You know, this really is a meteorological event that's going to continue to persist. But at least in eastern Missouri, eastern parts, the drought has been alleviated somewhat. But if you want to stay awake, really nightmares. This is water scarcity is predicted by NOAA into 2025. The entire southern hemisphere of the world is going to have water shortage. That means revolution, that means political foment, that means starvation. 2025, potable water scarcity, and it's not just drought. So that's something, we should worry about. Put that into that planning calculator here. Now, in spite of all that, I know that I'm, running out of time, so let me move along quickly here. A couple of investing truths. As financial planners, we come across this all the time. Also, as students, something I want you to very much be aware of. First of all, this kind of a market is all about risk management. Are there any soccer players there? You'll understand what this picture is about. Risk management. You know it's coming, plan for it, okay? What kind of risk are we talking about here? Business risk, financial risk, liquidity risk. No business grows at a consistent pace all the time. One of the worst industries in the world has always been the airline industry. Do you know, from the time Wilbur and Orville started up to now, this is an industry that has never made money on a net basis. Now, what a great business model that is, isn't it? The only time they do well is after bankruptcy, and you get into an economic expansion, and they fly nicely for a little while, and then they crash and burn. In fact, Warren Buffett was the one who said, if somebody had shot Wilbur and Orville out of the sky, it would have served us all very well. Liquidity risk. The sheep syndrome. Sell to whom? Your broker says to whom? Did you have anybody in mind? You can't get out of it. This is why I hate partnerships, anything that is illiquid. There are going to be times you want to get out. The only illiquid investment you should have is your house. And your house used to be quite liquid until you can sell it to absolutely anybody. That should be your only illiquid investment. So when you're buying anything, what you want to know, especially with the stock, is trading liquidity. When you have guys touting about it on television, I just love, does anybody listen to Kramer? Really? Really? Okay. Susie Orman, any of those? When they're telling you, buy white knuckle oil and gas drilling, it's the neatest thing since sliced bread. People go out and start buying it right away, and then all of a sudden the price goes up. How does that work? No supply, all demand. And then they start dumping it. All supply, no demand, right? That's exactly what happens. Turn off the TV. Stop listening to everybody. Me too. Focus on your investments, and liquidity risk is huge. Beware of loyal following on stocks. And again, this goes back to everybody loves General Electric until it totally blew up. Analysts are very slow to downgrade because they have to admit then that they were wrong. Here's how it goes. Buy, 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 buy. We're not covering it anymore. Okay? That's how it works. Cisco was the biggest case in point. Cisco, back in the height of the tech period, was up $150. And then it went to $120. It went to $90. It was still buy all the way. You couldn't give the stock away at $15, and it was a real company. Of course, it came back, but it was all valuation. No matter how good the company is, if you're paying too much for it, you're speculating. It's all about what is the price and what is it worth. And as soon as you have everybody loving the stock, it is time to sell. Nobody's going to tell you when to sell. Nobody wraps a brick around paper and throws it through the window to tell you when to sell. It's a discipline. And you have to have the discipline of selling, because Wall Street will tell you buy, 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 and that's it. You have to know when this thing is fully appreciated. Leave a little something on the table for the next investor, namely not you. Don't get in first, don't get out last. Take that 60% in between, leave the other 40% for the others on the table. Adjust when things don't land where they expect. Oh, was our industry guilty of this in 2008? It'll come back. It'll come back. 2009, it'll come back. Within our lifetimes, it'll come back. That's the way they have been trained, because from 82 all the way up to 1999, it always did come back. It made sense. But if nothing else, they didn't learn between 2000 and present, it doesn't always come back. Sometimes stocks die and go to stock heaven. It does not come back. So when you're going to put your portfolio together, you have to be rational about it. Does this make sense? Change your mind and move if it makes sense. Now here's the other thing. If you know an outcome is highly probable, don't do it and take a chance, okay? I have found from personal experience that prayer and hope are not useful portfolio management tools. Discipline is the only thing that counts in risk analysis. So that is the key thing. Don't ignore the obvious. I'm just a short topic here on retirement. Don't. Moving right along. Do you realize you're going to have $250,000 just to cover health care in retirement? Tell that to your clients. $250,000. Oh, and then you'll want food too, other than that. Who's giving you advice? State of Missouri has very few regulations on who can give you advice. It's all in how they change their names out there. Your CFPs, good stuff, okay? The discipline of it. People can trust you, but people have to be very, very careful about who's out there giving them advice. Wherever there's money, there are always scams. Here's the biggest problem we're faced: analysis paralysis. People cannot pull the trigger. They're afraid to move, they're afraid to put the money to work, and this is a huge problem because they're going to continue to get 1/10 and a poke in the eye with a sharp stick in the money market because of fear. It's not only a huge opportunity cost, it's costing you from an inflation standpoint. So from this point on, we are growing glacially, but it's not a market that's going to take everything up. You just have to have better vision out there and staying on top of your investments and being sure where you're going and does it make sense for your financial progress. And here is our blazing speed. The economy is going to move along steadily, in my opinion. I think about 1.5%. Sectors will do well and then pull back here. That's probably the key thing. But the biggest thing you have to face as a financial planner is an entire refocus on your nature of your customer, because it's not just about making money, but their needs right now. They want to talk, they want to listen, they're deathly afraid, and they have every reason to be. So it's finding the right things for them to do. I know I've exactly hit my time. If anybody has any questions, I'll move off to the side here. Thank you so much for your kind attention.
That was lively after lunch. I'll have to say that. Here's a little token of our appreciation from the university.
Thank you so much.
And, well, thank you for coming down. Are there any questions for her before I introduce Anna? Is there a question? Yeah.
What's your thoughts on the agricultural land, agricultural land shooting up?
Land prices, yes, agriculture prices. Two things on that. One, we have not hit the silly season on that because of the amount of the mortgages that they're taking out on it. It's very low interest. Certain areas are really good. You're bringing a lot of marginal land in production, which I think is absolute nonsense because we're going to have water problems. Illinois is going to have huge water problems, okay? So the pricing should be a real caution here. But I don't think it's a bubble at this point simply because interest rates are continuing to be low. Would I rush out and buy some? I don't know anything about it, okay? So you'd have to have somebody who really knows the quality of the property that you're getting involved in.
Early on, you seemed to indicate that Washington was exacerbating the problem. Do we
Yes.
see a hope there?
Oh, I have my solutions. See, here's the problem. You know what needs to be done. I know what needs to be done. Why aren't they doing it? Americans always vote, or they have been over the last 15 years, against their own economic self-interest. And I think it's because of lottery mentality. Everybody thinks that I'm going to win the lottery, and then I, too, will be putting on the Ritz, and I'll be out at the Hunya Hunya Country Club, and I will have to commiserate about these huge tax problems, and so they vote against themselves. All the legislation has gone through on taxing hit the middle class, and only nominally at the 1%. Okay, so that's the way the tax laws have been going. Protection of absolute nonsense tax breaks that have no economic merit other than to preserve somebody's tax bracket. Okay, but we continue to vote it. So who's to blame? We are. We're not informed voters. We are. We've got a problem here. And Washington will continue to buy our legislators as they have, the four major businesses continue to buy as they have been. So do I see a solution to it? Yeah, campaign finance reform. But one of the biggest reformers was John McCain, and he came out against it. He had a perfectly good law that he put through, and he wanted to loosen it up. And why did he? Well, all you have to do is there are several good websites that you can find out how much was contributed to his campaigns. Money talks. Think about who used to own Missouri legislature, right? Lock, stock, and barrel, Anheuser-Busch. Anheuser-Busch had more money out all over the state, totally preventing any new breweries coming in. And it wasn't until they were blown up by AB InBev, okay, that all of a sudden microbreweries are coming out everywhere. Love this stuff, okay? But that's competition. Had they taken it to the Justice Department, it probably would have been struck down. But oh my gosh, they had money going over the entire Missouri state. We're to blame. I think we've done it.
Join me in thanking her again.
Thank you.